In 2021, non-fungible tokens, or NFTs, became the hottest investment trend in the world, with celebrities, athletes, and everyday people spending billions of dollars on digital artwork that existed only as computer files. The NFT market exploded from almost nothing to a $40 billion industry in less than 2 years, attracting mainstream media attention and celebrity endorsements. People were selling digital images for millions of dollars, with some NFT projects making their creators billionaires overnight through speculative trading and FOMO-driven bouging. But by 2023, the NFT market had collapsed almost as dramatically as it had risen, with most NFTs becoming worthless and investors losing billions. Today, we're exploring how NFTs went from the future of digital ownership to one of the biggest speculative bubbles in technology history. This is the complete story of the rise and fall of NFTs, and what it reveals about hype, greed, and how bubbles form in new technology. To understand NFTs, we first need to understand blockchain technology and cryptocurrency, which are the foundational technologies that made NFTs possible. Blockchain is a decentralized digital ledger that records transactions and data in a way that is supposedly secure and unchangeable. Cryptocurrency like Bitcoin and Ethereum are digital currencies that use blockchain technology to operate without government control or central banks. In 2014, Ethereum blockchain introduced smart contracts, which allowed developers to create applications and digital objects on the blockchain beyond just currency. An NFT is essentially a smart contract on blockchain that creates a unique digital object that can be bought, sold, and owned like physical property. The key concept behind NFTs is scarcity. Blockchain creates a permanent record proving that a specific digital file is unique and owned by a specific person. In theory, NFTs could revolutionize how digital ownership works by creating verifiable scarcity for digital art, collectibles, and intellectual property. In 2017, NFTs emerged as an experimental technology with projects like digital collectible cats that people bought and sold on blockchain. CryptoKitties was mostly a novelty, but it proved that people would spend real money on digital collectibles backed by blockchain. For several years, NFTs remained a niche experiment in the cryptocurrency community, interesting to blockchain enthusiasts, but unknown to mainstream audiences. But in 2020 and 2021, NFTs suddenly exploded into mainstream awareness and became a speculative investment frenzy. Several factors contributed to the explosive growth: increased cryptocurrency adoption, stimulus money from pandemic government spending, and media hype about early NFT investors making millions. In March 2021, digital artist Beeple sold an NFT artwork for $69 million at a prestigious auction house, generating massive mainstream media attention. The BPL sale made headlines worldwide and convinced millions of people that NFTs were the future of digital art and investment. Celebrity and athlete NFT projects launched, with famous people promoting digital collectibles to their massive fan bases. NBA Top Shot, an NFT platform selling digital basketball highlights, became a massive hit with millions of people buying video clips as investments. Celebrities like Paris Hilton, Jimmy Fallon, and athletes openly promoted NFTs and discussed their personal NFT collections on social media and television. This celebrity endorsement created a social media frenzy, where people feared missing out on what was supposedly the next big investment opportunity. NFT collections with names like Ape Yacht Club launched and became status symbols, with ownership indicating membership in an exclusive digital club. Ape Yacht Club NFTs sold for hundreds of thousands of dollars each, attracting wealthy investors and celebrities seeking status and investment returns. The Bored Ape collection became so popular that owning one was seen as a sign of wealth and status in cryptocurrency and celebrity circles. This moment is crucial because it shows how NFT transitioned from technology to pure speculative asset based entirely on social status and FOMO. If you're watching this and you're thinking about how important it is to understand bubble psychology and how hype can drive markets, like this video to show that critical thinking matters, and subscribe because we're breaking down how bubbles form and collapse in every industry. As NFT prices skyrocketed, investment platforms and services emerged to help people buy, sell, and trade. NFTs. Cryptocurrency exchanges added NFT marketplaces, making it simple for anyone with internet access to participate in NFT trading. Millions of people who knew nothing about blockchain or NFTs jumped into the market hoping to buy low and sell high and make quick profits. The market became dominated by speculation rather than any actual utility or use case for NFTs. Beyond collectible status, most people buying NFTs had no intention of holding them long-term, instead treating them like stocks to be flipped for quick profits. This pure speculation created unsustainable price growth that was disconnected from any fundamental value or real-world utility. Art galleries and auction houses embraced NFTs as a new category of collectible art, legitimizing the market and attracting even more investors. Traditional finance companies and hedge funds entered the NFT market, seeing it as a potential new asset class with huge profit potential. Influencers and content creators launched their own NFT projects to capitalize on the trend, often with minimal innovation or actual value. Many of these influencer NFT projects were essentially cash grabs with no real technology, art quality, or community value. The market became saturated with low-quality, derivative NFT projects that were purely designed to extract money from FOMO-driven buyers. Scams and rug pulls became rampant, with NFT projects disappearing after collecting millions of dollars from investors. In a rug pull, project creators would hype an NFT collection, collect money from buyers, and then disappear with the funds. Investors lost millions in these scams, but the market continued, growing because new money kept flowing in from people chasing past gains. By late 2021, the NFT market had reached peak hype, with media coverage suggesting NFTs would revolutionize art, gaming, and digital ownership. But the fundamental problems with NFTs were becoming increasingly apparent to anyone examining the technology critically. First problem: most NFTs had no actual utility beyond status and speculation, with no real-world use case that justified their value. Second problem: NFTs were supposed to give artists control of their work, but most NFT sales generated minimal ongoing income for actual artists. Third problem: the environmental impact of blockchain technology, especially energy-intensive proof-of-work systems, made NFTs environmentally destructive. Fourth problem: the legal status of NFTs was unclear, with no regulatory framework protecting investors from fraud or scams. Fifth problem: digital ownership through NFTs was illusory, because buying an NFT didn't actually prevent the image from being copied and used by anyone else. Sixth problem: the entire market was based on pure speculation and FOMO, with no sustainable business model underlying the value. By early 2022, the market began showing signs of weakness as cryptocurrency prices fell, and investors became more skeptical about NFT value. High-profile NFT investors and celebrities who had promoted NFTs faced backlash and criticism for promoting speculative assets without warning about risks. The collapse accelerated rapidly as investors rushed to exit positions before prices fell further, creating a cascade of selling pressure. NFT trading volumes plummeted from billions per month to millions as the speculative frenzy evaporated. NFT floor prices collapsed, with collections that sold for thousands falling to hundreds or even single dollars. Many NFT holders who bought at peak prices were left holding digital assets worth a fraction of their purchase price. The Bored Ape Yacht Club, which was selling for hundreds of thousands of dollars at peak, saw prices fall to tens of thousands. NBA Top Shot, which had been promoted as the future of sports collectibles, became virtually worthless as the market collapsed. Celebrity NFT projects disappeared from social media as famous people who had promoted NFTs distanced themselves from the trend. By 2023, the NFT market was a fraction of its former size, with the industry returning to niche cryptocurrency enthusiasts. The collapse of NFTs revealed important lessons about markets, technology, and human psychology that are relevant to all industries. First lesson: speculative bubbles form when new technology creates excitement, but fundamental value is disconnected from asset prices. Second lesson: celebrity and influencer endorsement can drive investment regardless of underlying merit or utility of an asset. Third lesson: FOMO is a powerful force that can override rational decision-making and critical analysis of investments. Fourth lesson: without regulatory oversight and consumer protection, new markets become playgrounds for scams and fraud. Fifth lesson: environmental and social consequences of new technology are often ignored in pursuit of profit and speculation. Sixth lesson: The greater fool theory drives bubbles, where investors profit by finding someone willing to pay more, regardless of intrinsic value. So here's my question for you. What other bubbles are forming right now in technology and finance that people are ignoring? How can investors avoid being caught in the next speculative bubble, built on hype, rather than fundamentals? What would you do differently if you were aware of these bubble warning signs in real time? Let me know your thoughts in the comments about NFTs, bubbles, and the psychology of speculative investing. Like this video if you found the NFT story as important as I do. Subscribe to this channel because we're analyzing the next bubble before it collapses and costs people billions. Because the truth is this, NFTs weren't unique. They were just the latest iteration of speculation and bubble building that happens repeatedly in new markets. Understanding how bubbles form helps you avoid becoming a victim of the next one, whether it's in technology, finance, or any emerging industry. The NFT collapse serves as a permanent reminder that hype and celebrity endorsement are never substitutes for real value and sustainable business models.